we decided that we will start with a 2x multiple, right? The returning customer rate isn't great. I think where the store does pretty well is the average order value. That's relatively high given the conversion rate. Again, profitability is pretty average. And all the other factors I essentially discussed. What happens is I get 120 points. Pick this through. So having gone through all those factors, right, that this store should be valued 3.2x multiple on the profit that it has made, leading to a valuation of 812K. All right, guys, today I want to talk about store valuations specifically for your e-commerce store and hopefully even Shopify store, since that's really our expertise. And I really want to guide you step by step on how you can value your Shopify store. If you've watched some of my previous videos, I actually have already a few videos on store valuations where I talked, for example, about how we scraped some of the biggest exchanges, right? So for example, this is Shopify Exchange Marketplace. It's no longer available, but we have scraped this data before it was shut down. You can see those are, a bunch of stores that we've mapped in terms of monthly revenue versus asking price. And of course, you can see that the higher the revenue is of a store, the more the valuation of the store is. Of course, that's one of the important criteria, but you can still see, even though there's a general relationship, right, that there's quite a bit of variance. And I really want to talk about the other factors that really play into the store valuation and really, show you how you can quantify every single one of those factors for your store and really play a little game, if you will. So let's jump straight in. All right, guys, so let's really dissect the e-commerce valuation of your store. And in this video, I'm actually going to value your store. So we're going to go step by step. And at the end of the video, believe it or not, you will get a pretty accurate valuation of your Shopify store or e-commerce store for that matter. So where do we start? So I already mentioned this graph where we've essentially scraped hundreds and thousands of stores, also across other graphs, where you can see that there's a rough correlation and relationship between revenue and the valuation of the store, right? So of course, the more revenue you make, the more the valuation of your store, roughly speaking. But what we really want to focus on is actually the net profit multiple. So what does that mean? This is actually a very standard way to value businesses, also across many different areas or pretty much all areas. But I'm really going to focus on the kind of small sized e-commerce segment. And here the same principles apply. We're going to take the profit that a given store makes, let's say in a given time period, typically it's a year, and we're going to apply a multiple to that net profit. And through that, we're going to get the valuation of the store. So that's going to be the rough idea. The big question is obviously what is that multiple and how does that multiple change given all kinds of different factors that your store has. And of course, a business, which obviously a Shopify store has so many different dimensions and nuances to it. And we're going to try to quantify that as much as possible. It's obviously not perfect, but I think we can get a relatively accurate valuation by the end of this video. First of all, just the graph that you saw, I just took a screenshot of it and I divided it into different segments. Why? Because one of the most important factors of what multiple you can essentially demand for your e-commerce store is actually the revenue segment, the size of your store. And this is a general phenomena, which I think is pretty interesting, that what you see, and I try to visualize this in this graph, and this is not drawn to scale, but I think it makes the point that the bigger your store is, the higher the multiple you can demand. Why is that the case? Because the bigger the business is, generally speaking, right, even outside of e-commerce, the more stable it is, the more it has already proven itself, it has proven its product market fit, the more kind of it's clear that the lifetime of that store will, it's going to stick around for longer because it already reached a certain scale. Let's say if it's already making millions a year, right, then that store is generally a less riskier asset. Again, keeping all other variables constant than a store that's just making 10 or 20K a month, right? And through that, it's able to demand a higher multiple. Also, if a store makes much more in revenue, the market just becomes more efficient. That means that the buyers are more sophisticated, right? Again, if someone's buying a store that's making already 15 million plus in revenue a year, then the buyers are also much more sophisticated in valuing the store. The price discovery and generally the efficiency is such that those stores get valued on a much more exact basis. And through that, also the multiples are higher. So that's generally the point I want to make. And if you're just starting off and you have a small store making just, a couple, 10, 20, 30K a month, right? Then the multiples will be much lower. And generally, I think, going in the side segment of making between, say, just a couple of K a month all the way to 100K a month, right? Generally, the multiple you'll be able to demand is anywhere between 1 to 3x of your annual net profit. Of course, this can be higher, this can be lower. We're going to discuss all the factors that essentially make up this multiple on a more exact basis, but that's the starting point. So this is going to be the format of this video, and I'm actually going to guide you step by step. So what you just do, let's take a store that you either already have or that you're thinking of launching, and you can just pretend like those are the figures that you have or expect to have, and I'm going to guide you. I'm going to essentially go through an equation where you will be able to value your store. So if you're making between 100 to 1K in revenue per month, just start with a 1x net profit multiple. 1.2x if you're making between 1 to 10K revenue per month, so on and so forth. So 1.5x if you're making between 10 and 50K, 2x if you're making between 50 and 150K, and then finally 3x if you're making 150 to 300K. So let me actually, I'm also going to use some of our stores to make those examples a bit more real and authentic, because obviously I operate a portfolio of stores, and I'll use some of them to make this point. So I actually pulled up one of the stores here, and this is just a month. So let me quickly pull up an entire year. Let's just take the last 12 months, which is, I believe, what I used for the slide. So we have June. So here we have selected June. So we'll just select July till end of June. So there we go. So exactly. So that's the store where it made, in those 12 months, it made it slightly above $1.8 million. And if you go back to the slide, right, what does this mean? That what we're going to do is we're just going to calculate the net profit on an annual basis for a given store. So just do the same thing for your store. In this case, for this example, the store has a net profit of 14%. We're going to have a separate slide just on the profit figures. So don't even think about inflating this figure. That's a very common issue. So do not inflate this figure. But to make this point clear, let's just say that this store makes 250K in net profit or EBITDA. I'm going to use those terms interchangeably here, which isn't perfectly correct. However, given most of the small stores in this size segment for Shopify that I'm going to be talking about, those figures generally are very similar to each other, just because they tend to drift away the bigger, again, the business becomes, because there's all kinds of accounting considerations. But anyway, just to pre-warn you, I will use those figures interchangeably. And if I quickly do the math, and we take 1.8 million divided by 12, I think it's slightly above 150K a month on average. So, but I will be a bit tough on myself, and I'll actually start on a 2x multiple. So I'll pretend that I'm still in this segment of from 50 to 150K revenue per month, because I think it's right at the threshold of 150K. Let's be conservative. So just to give you an example, with this store, it's going to start on a 2x net profit multiple. And we're assuming a annual profit of around 250K. But we need to calibrate this multiple, because it's just not as simple as taking the profit and just slapping on a multiple on it, right? As we know, every Shopify store, every business, it's multidimensional, it's complicated, it has a lot of nuances, a lot of things are going on. And we're going to go through some of the most important factors that we can quantify so that you can actually get a more accurate valuation. All right, guys, so this is really where the game starts. I'm going to go through 7 factors where we're going to quantify exactly, given your store and also examples from some of my stores, how exactly all those different factors essentially allow you to calibrate that net profit multiple for you to actually get the most exact valuation of your Shopify store. So factor number 1, revenue history. I think it's obviously important to note that the longer your store has been around, the more of a multiple it can demand. For now, we're just going to essentially give you points, and I'll tell you in the end how those points convert into adjusting that multiple. So naturally, I think I don't have to explain this too much, right? If your store is around, and again, this is talking about smaller e-commerce stores, not public companies, you don't need that much history. But obviously, if you've been around already for a couple of years, you kind of shown the seasonality, you've gone maybe potentially through some cycles, you've not only shown how you performed during COVID, but also after COVID, all those things, right, essentially allow you to make a stronger case. So if your store does not exist longer than 1 year, 0 points. If you're already above 1 year, but between essentially 1 and 2 years, that will be 10 points that you can essentially add to your evaluation. Then between 2 and 3 years, that's going to be 20 points. Between 3 to 5 years, 30 points, and above 5 years, 40 points, right? So that's essentially the point system that we're going to work with. Again, I'll explain very soon how that actually converts. And there's going to be a reveal in the end of essentially how to get a very accurate valuation on your Shopify store. So that's factor number one, relatively straightforward. Factor number two, customer retention. So customer retention, and again, those are all designed to be, very simple for you to find, right? I specifically chose the most important factors that you can find immediately when you go under your Shopify store. So obviously, you know how long your Shopify store has been around. That was factor number one. Factor number two is if you go under your analytics dashboard, you will see this returning customer rate, right? And this returning customer rate for this store that I've already used as an example is just above 6%. To be honest, that's not very good. And you'll see now how many points you would get if you have a similar returning customer rate. I have another store, which I pulled up here, which has a returning customer rate of almost 58%. So you can see that there's a huge variation in kind of that metric that different stores have. And I actually have another store which is in the middle between those two stores, and then there's a fourth store which is really bad in terms of returning customer rate. And again, it obviously depends if it's a subscription product and whatnot, but generally this is the factor number two that I want to focus on. If you're below 10%, like I just showed you for the 1.8 million store at 0 points, to be honest, below 10% is just not something that is, it's fine depending on obviously your business model and what you're selling, but it's not something where you can really demand a higher multiple already. However, if you're already above 10% and up to 25%, I think that's 10 points that you can give yourself. Between 25 to 40%, that's 20 points. Again, the usual spiel here, between 40 to 60, 30 points, 60 to 80, 50 points, and above 80%, 70 points. So that's even an additional gap, at which point you must be really having a subscription product. And I think that just comes, that just makes your store a much stronger business ultimately, right? If you just have a very strong reoccurring customer base that literally, again, comes back the next month. And if you have more than 80% of your customers that come back every month over and over again for your Shopify store, I think that is the strongest you can be in this metric. And of course, again, those are relatively broad categories, but sure, you could say above 90%. But the point is, I think this is already, you're in the top, I think even in the top 1 or 2% if you're above 80% from all the data that I have seen and scraped, and also the data that I have from my own stores and all the other stores I've been involved in. So that is factor number two. So keep those points in mind, maybe write them down somewhere on the side. And let's move on to factor number three. So what is factor number three? Factor number three is AOV times your conversion rate. So this is a bit of a strange one, although it's not strange the moment I explain it. And that is that you have an average order value, which you also see on your Shopify Analytics dashboard, in this case, $183, and you have your conversion rate. And I'm going to really take this 1.65%, which is the sessions converted, obviously the percentages of website visitors who've actually made a sale on your website, right? Of course, we also have add to cart and checkout conversions here, which are also interesting, and I have a separate video on that. But here we're going to really focus on the sessions converted. If you multiply those two figures, right, essentially what you're going to get is a dollar amount, which essentially what that dollar amount is the amount of revenue your store makes per 100 website visitors, right? Why I actually want you to multiply those two numbers, and I'll just take each one as a separate factor, is that obviously your conversion rate is a function of your average order value, in the sense that if you have let's say you have a 1% conversion rate, it obviously makes a huge difference if on average you're selling a product for $30 or for $300, right? So you can have a much lower conversion rate if your average order value is much, much higher, right? Because again, for each person you convert, you're getting way more revenue. And that's why multiplying those two numbers essentially allows you to understand that metric, I think, in one go. And again, I think a very important metric to essentially determine how valuable your Shopify store is. If you're below 50, that's again 0 points. I actually think you're barely going to be profitable. I'm actually not quite sure if you're below 50, how you're making a profit at a big enough scale. It is possible, like if you're really, kind of pushing the envelope in terms of the margins that you're also willing to accept. If you're between 50 and 100, that's 10 points. Between 100 and 200, 20 points. Between 2 and 300, 30 points. Between 3 and 500, 40 points. And above 500, 60 points. And again, the thing above 500 is also already very impressive. And again, I'm going to show you a few examples. If you take if you take this store, right, I believe, and again, I should have calculated this beforehand, but I think we're going to be around the 250 mark. Exactly. I think, we're going to be in between this 2 and 300 category, right? So this store would be able to get 30 points. And I actually think this is one of the strengths of the store because the average order value is quite high, right? So on average, we're selling something every single time someone makes a purchase, right? On average, it's above $180, which is relatively high, and we still have a conversion rate that's above 1.6%. However, this store, for example, this is really where I think this metric is much stronger. And again, this is a different currency, but the point will still be made. Here, the conversion rate is above 5%, right? So it's very high. And the average order value, so actually if you convert this into dollars, it's something like $100, roughly speaking. So here we're actually going to be above the 500 mark. And that is really because the conversion rate here is quite high. I have another store, which I just didn't pull up at the moment, where we have a conversion rate below, it's like below 0.5% even. And even though the average order value is, I think, $130 or something like that, it would definitely be in the lower category because the conversion rate is just very low. And of course, last thing I want to say here, you will be able to demand a higher multiple if that number is higher and definitely above 500, because in any case, let's just assume that you're able to get a 1% conversion, right? That means that you, on average, if sticking to the 1% conversion assumption, on average, you need to essentially be selling something for more than $500 every single time someone makes a purchase on your store. Or let's flip this around, right? The reciprocal of that is essentially, let's say your average order value is $100, then you actually need a 5% conversion rate, right? That's the two different ways that you can essentially get a score of 500. And if you're above that, I think you're in really good shape. So that was factor number 3, and let's jump to factor number 4. All right, guys, factor number 4, net profit margin. I know we've obviously talked already about how it is your profit that you then multiply to get your valuation, but I think it actually deserves its own slide, because how profitable your Shopify store is, right, is in and of itself a great indicator of how valuable your store is, right? So obviously, if you're super profitable, you're doing something right. You're adding more value than most other competitors, let's say, in your distribution, in your cohort. And with that, I think you just deserve a higher valuation. And obviously, it's also an indicator of many other good things that might be happening in your Shopify store, right? Obviously, the defensibility, that's difficult to copy your store, that for whatever reason, you're able to, again, add this disproportionate amount of value given, again, the expenses that you need to incur to add this value to your customers. And that being considerably higher is just a very great indicator, and also has great spillover effects, I think, to many other factors, but we'll get into that. So first of all, first category is actually if you're unprofitable. I know this in and of itself doesn't make sense because you can't multiply a negative figure to then get a valuation. I still included it here because I think there are some edge cases where generally you can have a great store with a clear path to profitability, and the buyer might still be very interested if that fits his kind of thesis of how he or she can turn it around. But Generally speaking, I think it's going to be much, much harder to sell a store that's not profitable, again, year round. And I've just said minus 50 points. In reality, it's probably going to be more, but I do think there's some situations where it is still possible. That being said, of course, most buyers, and again, focusing on that smaller e-commerce segment, they buy a e-commerce store which is supposed to be a profitable asset, right? It's supposed to give them a yield, a ROI, right? Something that they can then work and grow to essentially make a financial return for the most part. And that's why if you're unprofitable, I think that's really something where you should maybe consider not selling your store and really focus on making it profitable first. All right, if you're between -5% and 5%, so essentially break even, you're kind of hovering around the break even point. Some months you're profitable, some months you're not, but it kind of averages out. I think that's pretty neutral, so 0 points. If you're between 5 and 15%, again, consistently, I think that's where already the first points come in, the first positive points. That's actually where I think most stores are. If you look at kind of the distribution of all e-commerce stores, they're in this category. And I do think it still, again, should increase your valuation by a little bit. Why? Because if you're consistently showing that, let's say on average, you're making 10%, and that throughout the entire year, again, we're talking about profit margin last 12-month average, or whatever if your store only exists for like 9 months, and just take the entire history of the store. But if you can show that on average throughout the seasonality, throughout, potentially different cycles, then I think that already in and of itself is pretty valuable and kind of puts you ahead of the pack in many ways. Right, then between 50 and 30%, already pretty profitable, 30 points. Between 30 and 45%, 50 points. That's obviously already, you're kind of really in the top profitability, I think, of all the stores that one can find. And if you're above 45%, I think here I really want to make one point very clear, is that a lot of those profitability figures are super inflated, especially if you go to platforms like Flippa and even back in the day of Shopify Exchange. You couldn't hide the revenue figures because they would be pulled directly from your Shopify backend or from Stripe or whatever it might be. But profitability, obviously, no one knows all your costs exactly, right? And that's where everyone has different definitions of what costs to include, what costs to exclude, and that's where you run into many of those issues. And what I'm talking about here is your true net profit after all the costs associated with running your store, like literally all of them, right? So not only the obvious ones like COGS and shipping and the transaction fees you pay to Shopify and PayPal, and all of your marketing expenses and all the Shopify apps and all the subscriptions, et cetera, but also all the operational overhead costs that you might have, right? If you have a CRM agent, or even if you, for example, have a revenue-based financing loan or some sort of loan that you use at some point, I would include the fee or the interest on that as an expense. If you've used freelancers at any point in time, really including that, any kind of subscriptions outside of the main Shopify subscriptions, like you even use Gmail to run your store in any shape or form, include that. So really your net profit. And I think there, I really don't think above 45% is common at all, right? I think it's extremely rare. And a lot of people put it, but it's not the reality. If you dig a bit deeper, then it tends to be one of the upper categories. So I would first encourage you to do a bit of soul searching and see that maybe if you think you're above 45%, you're not actually. And the way you position that to the buyer might be different, but I think for this exercise, just to actually understand your valuation for yourself, first, I would say that this is extremely unlikely. But if you're actually consistently above 45% as a D2C e-commerce brand, then I think this deserves 100 points, which will definitely boost your overall valuation. Again, we'll get into how exactly it does that very soon. But for now, that's a split for factor number 4. Let's move on to factor number 5. All right, guys, factor number 5, and that's the growth/trend of your store. And with that, I just mean general kind of how's your store performing in the last 3 to 6 months? Are you growing? Are you not growing? Did you grow very nicely and you had a sharp drop off? So that's, I think, also a very important factor, because a lot of what you see, actually most listings that you see are stores that have been doing really well historically, right? But started to crash for whatever reason and now just want to sell, right? And of course, that is, from a seller's perspective, the worst time to sell, because clearly something's going wrong and you just want to sell your store in kind of the worst possible timing. And I think there's this quote, I mean, not necessarily a quote, but I think the best time to sell your store is when you don't want to sell your store because things are going so well, right? And a lot of people do the complete opposite where, they don't sell their store when things are going well. They wait, or they don't wait, but something goes wrong. The ROAS drops. They're literally 80% off their peak just a couple of months ago, and now they decide to list their store. So obviously, try to avoid that. But again, trying to quantify every single factor. If you really had negative growth last 3 to 6 months, and that is I define this as a above 70% drop from the previous peak, very, very common. I think this really needs to, this is really going to hurt your valuation because even if you've made, let's say from the first 9 months of that year, you've made like 5 million, right? And then you just dropped off 80% lower in the last 3 months, right? Or 2 months. This is going to raise a lot of questions, right? And of course, there's some situations where you can explain specifically what was going on. There was like some logistics issue, supply chain issue, but even there, regardless of the rationale, I think it's going to hurt your valuation. So keep that in mind. Okay, then second thing is negative growth, but not this aggressive, because again, I'll actually show you some examples later on perhaps, because if you just go under the listings and you look at the revenue history, a lot of the time it literally goes up and then crashes and then it just stays flat at a very low level. So that's category number. There is a category number 2 where there is a drop, but it's not as big. It's somewhere between, let's say, 30 to 70%, still pretty big. But anyway, that's negative 50 points. Okay, no significant growth or decline. Naturally, that's going to be kind of the neutral 0 points. The way I define it, again, talking about smaller e-commerce stores, they are volatile by nature. If you're making below, again, 5 million a year, the month-to-month fluctuations can just be plus minus 30%. There's obviously seasonality. There's a lot of things that I'm putting aside, but generally, again, we just know how it is with ROAS fluctuations, and again, just going, sometimes shifting on and off different marketing channels, and you just have those fluctuations. And there's many other criteria as well. So that's 0 points if you just have those natural fluctuations. If you can show, however, growth, again, this goes the other way too. If you list your store on a high in terms of performance, I think here you can get 50 points and 100 points. If you can really show in the last 3 to 6 months that you've been consistently growing and that your last 1 or 2 months, this actually makes a difference, because again, here we're talking about smaller stores where, again, they don't have that much history. If you can just show in the last 1 or 2 months that this is the all-time high, for, even like without much rationale, this will really, really boost your valuation. So keep that in mind and add the corresponding amount of points. Okay, factor number 6, fulfillment model. I actually think this is important and also something that's missed quite often, because how you fulfill your products, and obviously the buyer will need to take over that fulfillment model, right? And there's just some fulfillment models that are much more convenient and easier to take over versus others. If you fulfill your items from your own home or garage, it's going to be, first of all, very difficult to shift to the buyer, and I actually think this will come with negative 50 points. And there's going to be all kinds of issues with inventory. If you have inventory, which you most likely do if you're fulfilling from your garage, that you will need to essentially figure out. And it's not necessarily always a bad thing if the buyer knows exactly how they can shift it to the fulfillment model that they want, but there will, by definition, need to be a shift. And I think that is just a painful aspect for most buyers, where it will probably be a talking point in terms of lowering the valuation. Okay, if you dropship, that's neutral. A lot of people dropship, and I actually think it's not necessarily good or bad. It really depends on other things. However, if you have already a fulfillment agent managing your logistics and do so efficiently, then I think this actually deserves 15 points. If you have a 3PL fulfilling the majority of your orders, so you actually have a professional 3PL that literally does everything for you and it's completely automated, you ship out on the same day or the next day, depending on the cutoff. You have an automated way to deal with refunds. Your packaging is professional. You maybe even have a leaflet, or at least you have the option to do that. You have the option for overnight shipping, 2-day shipping, express shipping, expedited shipping, etc., etc. If you have that system set up, this is obviously this shows that it's already a more sophisticated, professional store ultimately. And that, I think, can also help you argue for a higher valuation. Finally, and this is also, of course, for the bigger stores, I think they're already making a couple of million a year. If you have a network of 3PLs fulfilling pretty much all of your orders, so that, I think, is really where you can show your kind of sophistication and ability to essentially run a store on a higher level. If you even have a network of 3PLs across different countries, potentially even, that again have automated everything, and there you even have the flexibility of kind of shifting inventory across different 3PLs, scaling very fast if you already have this network set up, and a lot of other benefits that come through that, while making it work out with all the other factors, right? Still being profitable and so on and so forth. So plus 50 points. That was factor number 6. And finally, bonus round. So we're almost at the end. If one of those things apply, then you will just get bonus points. That will help out your end valuation. So number 1, if you have more than 3 paid marketing channels with consistently positive ROAS, above break even, then I think that's very strong. That's plus 50 points. I don't think I have to explain why. Obviously, being diversified in terms of several different paid marketing channels with a positive ROAS that you can show historically, or for example, your Pixel or other data analytics tools have been seasoned, and you have a lot of data to back up why also this performance is going to continue and why it's difficult for competitors to copy you. That is extremely powerful. It might even be more than 50 points, but I really try to balance this compared to all the other factors. And again, I'll explain in a second. You private label your product and have trademark or copyright protection. I think that's also pretty great if you have that, and that comes also with 40 points. Again, this on the angle of defensibility and being able to protect your product, whatever it is, in the long term. Also, when if the buyer makes the acquisition, that they will be able to benefit from those protections. Next thing is for customer service. If your agents have been trained to provide fast and customized customer service, I think that's also a huge plus. Again, I have a separate video actually on most of those points, but definitely have a long video on CRM showing you how you can set up the CRM for your Shopify store to be completely, not completely, but very, very close to fully automated, and have agents that are essentially trained to the point where that's kind of almost running on autopilot. Finally, you're not dependent on one product or one supplier to operate your store. Again, this is very, very common that stores are dependent on that one product, or especially one product with one supplier, where if one of those two things break, then the entire chain breaks. And that is obviously a vulnerability, something that I think if you do have not necessarily negative points, but if you don't have that, if you have a wide enough product suite that's diversified and have different suppliers you can fall back on, which you have pre-vetted and have built a relationship with, and generally can also negotiate between suppliers to make sure you're getting the most competitive prices, 30 points extra for that. And then finally, it's a bit blocked here, but high potential to expand geographically. That's what it says. Again, everyone says they can expand geographically, and in reality, few people can, because they would have done it themselves if they already could. But if you're honest with this criteria, there are just stores that, for whatever reason, are only selling in one country, and they could copy paste that into a few other countries, not necessarily, expand across the world, right? But especially on some paid marketing channels, there are just stores who, successfully run ads in the UK or in Canada, whatever it might be, but never tried, a neighboring country or whatever that's also English speaking, or those obvious things. And they're 25 points. Okay, so we're done with the points. Take a minute to actually add up all the points of your store. And I'm actually going to go through an example myself. All right, guys. So we've already added up all the points, hopefully, and I'm going to guide you how that exactly works and then converts into your ultimate valuation with the first store that I showed you, the one that in my example was making 1.8 million, slightly above $1.8 million in the last 12 months. So if we essentially take that store, and I'll again run through the most important metrics, what ends up happening is that it's plus 20 points, then 0, then plus 30, plus 10, plus 0, plus 30, plus 30, which gives my store 120 points, right? So do the exact same thing for your store. And again, if we actually go to that store, you will see that, again, we decided that we will start with a 2x multiple, right? The returning customer rate isn't great. I think where the store does pretty well is the average order value. That's relatively high given the conversion rate. Again, profitability is somewhere in the middle, so also pretty average. And all the other factors I essentially discussed, you can see that what happens is I get 120 points, and generally I think the store is doing relatively well. So I don't have any big negative points, right? In terms of logistics, I think it's pretty well set up. In terms of CRM, in terms of some of the bonus points, I think it does also score quite well there. And I've tried to be conservative where possible. But okay, but what do we do? You can already see it here. What do we do with the points? The points we divide by the divisor, and that number can be a different number depending on several macro, I think, criteria, right? And generally, how strong we want to give a weighting to those points, right? However, I try to do it so that at this moment, right, you roughly only have to divide those points by 100, so a nice round number, to get a multiple, which in this case is 120 divided by 100, obviously 1.2x, which is the multiple that you can add on to the multiple that you started, right? So what does this mean? Let's click this through. So this actually means that if you remember from my initial example, right, this store making 250K roughly in annual profits, we started with a 2x multiple, right, to be conservative. We can now add 1.2x, right? So we could, let's say, argue, having gone through all those factors, right, that this store should be valued initially, right, maybe as an asking price that we can go and list and really argue for 3.2x multiple on the profit that it has made, leading to a valuation of $812K. So that's my example. Again, do it for your own store. If you want, comment below and let me know how that actually worked out for you. If you think certain weightings and certain points could be adjusted, and it definitely can be. Of course, this is not perfect, and I've essentially run through those factors through some of the other stores I have and other stores I'm also involved with, and it does, I think, do a relatively decent job. However, of course, there are other factors as well, and let's go through some of those other factors. And I think, obviously, this is just a starting point. This valuation is something that I think is useful for you, and also to think about the most important factors that you can also present your store in the best light when you sell your store to a potential buyer, right? Where you can, for example, highlight, if you have a high retention, that this is kind of the a great part of the store, and why, again, that deserves a higher valuation. But anyway, other factors is obviously the macro environment. There is just demand and supply for such stores, and this real asset class of small e-commerce store just changes over time. Of course, interest rates and everything going on in the macro environment has a direct influence on those valuations, on all valuations. Obviously, e-commerce stores not being excluded here, and that's why those multiples, they're just generally going up and down, right? And that's why, again, this divisor of 100, that might also change depending on the macro environment. Obviously, keep that in mind. And there's obviously certain times in terms of, again, monetary policy and fiscal policy that literally leads to it being a better or worse time for you to sell your e-commerce store. Second thing is your negotiation skills. By the way, all of those valuations, especially if you go and look at exchanges like Flippa and so on and so forth, they have huge outliers. Yes, there have been stores, and I've seen it for myself, that list for 300K and they end up selling for 100K, and also the complete opposite, where they list for 300K and then they end up selling for 800K. Those outliers do exist, right? But again, this hopefully will allow you to have a good starting point in terms of your evaluation. And then obviously, again, your negotiation skills. Obviously, if you're a very good negotiator, then presumably you can also squeeze out some more value. Okay, acquire intent and synergies, and I'll move my camera here. what the buyer wants to do with your store and what they think they can achieve, right, in terms of the synergies and just generally maybe, adding that store to a existing portfolio, or maybe again their expertise in a certain vertical, or them being able to fix a very specific problem of your store because they are very confident that they are able to do that, also plays a huge factor, right? And that's even like a store that might not be doing too well, but for whatever reason, the buyer sees huge potential specifically because they think they know how they can fix all those problems, can actually lead to a much higher valuation or lower valuation, right? If the complete opposite can also be true. It might just be that you have this very annoying logistics or supply issue with your store, and that buyer, he might like your store, but he just knows that he won't be able to solve that problem either, and that will also be a huge minus, right? So that's obviously also a very important factor. There are store intangibles, not to forget that, right? So I try to focus on very concrete factors that you can quantify, right? Your retention, your AOV, your profitability, right? Those are very concrete numbers that we can find out and essentially quantify and try to factor them in as much as possible. And I already went in the bonus round and kind of a bit more of the softer stuff, right, that your store does. But beyond that, there is obviously intangibles. That's really more applicable for bigger businesses, but I think here as well, just on a smaller scale, you might again have some sort of brand content or different kind of potentially assets there, right, that are intangible but that you can argue for. Again, domain names are very powerful sometimes, right? If there's literally domains that get sold for 100K, and it's just again the name of your website that might in and of itself have a value which isn't that obvious when you list your store, right? But definitely there are intangibles like that, and this can also come in terms of obviously branding and the content that your brand already has and can be used. And I already mentioned things like copyright and other protections. I think that also kind of goes into that, and of course it can go all the way to actually having a patent protection for one of your products, which of course will also be super valuable. And anyway, there's a separate way to value that. And finally, timing. I don't think I have to explain that, but some people call it coincidence, some people call it luck, some people call it fate, some people call it just being in the right place at the right time. Some people call it momentum, but obviously the way you list your store and the way just those negotiations go with kind of a wide variety of buyers is also subject to a bit of your lack of timing, let's just call it like that. And generally if you list a store, being very, very kind of aggressive in terms of talking to a lot of buyers in as short of time period as possible, I think is generally good advice, because then you can essentially get that momentum and have a lot of buyers also compete and bid with each other. But of course, it just depends what you want to do. If you just want to talk to one potential buyer once a month, then generally that's going to hurt your valuation as well, I would argue. But that's obviously, you'll be having good reasons for that as well. So those are the other factors to consider. Hopefully this was helpful for you to understand how valuable your Shopify store is. Let me know your thoughts. And of course, something that, I'm also looking to improve. By the way, if you are thinking of selling your Shopify store, also reach out to me. I might be interested in buying some stores as well. Hey, before you bounce, check out some of the Shopify apps that we have built for our own stores, which might be useful for your stores. So we're very excited to hear your feedback, and check it out in the link below.